Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of Chat for November 7th of 2022. Disclaimer for important information. At the start of this week, I want to take a look at the expected Fed funds rate here. Obviously, a lot of speculation over future rate increases, and of course, we had the very important Fed rate announcement last week, which I think, frankly, was every bit to be expected, not only in terms of the rate increase, but also the rhetoric coming from Fed Chairman Powell following that in the press conference. And so clearly the tone that he carried was that the Fed was going to continue to be aggressive. Data points are still suggesting that the economy is not faltering. It may be slowing down, but maybe, as I've said many times, not slowing as fast a pace as the Fed wants it to. But in any case, this represents the consensus estimate and the changes in that consensus estimate over periods of time on what that terminal rate is going to be and how long we're going to witness rate increases before they crest and begin to roll over. And so we can see here, as you look at this timeline, we're kind of at the tail end of 2022, of course, and so heading into 23 expected to be more increases as we see here that at least on the consensus number, you can see just 1 week ago, 1 month ago, those numbers were less than they were. I think the terminal rate a month ago was about 4.5%. A week ago, it was about 4.75, and then now after the Fed rate increase that you can see here, it's basically 5.25. So, and that rate increase looking to be, or that crest in the rate looking to be somewhere around the early part of the second quarter there, which is very consistent with my feeling that we're going to have 6 more months of really turbulent conditions, uncertainty, and you're really not having a sense of the trajectory of where inflation is going to go. And of course, uncertainty over inflation is causing the Fed to err on the side of aggressiveness. And so, as soon as you get more clarity on that, then you begin to get more clarity on what the Fed's going to do. And right now, based on the rhetoric coming out of the meeting last week, they're expected to continue to be somewhat aggressive here. Here's our terminal rate. You can see, as I mentioned in that previous chart, this number has gone up consistently as we've, seen the rhetoric reinforce itself in terms of the Fed rate increase side. Fed voting members out there talking in public forums and giving speeches and things like that. You can just hear the tone and also the press release and the language in the press release for the Fed when they announce their rate decisions, has become a little bit more hawkish, I should say. And you can see that reflected here over time as we've come from basically July in the summertime, up to now. And you can see that how those rate increases have moved much higher. Here's the 10-year to 2-year government bond spread. And so when this is negative, it tends to foreshadow recessions. And of course, we have that now. There have been a couple of false positives, I'd say, and but that did not actually translate into recessions. But for the most part, it's a pretty reliable indicator. And of course, we've actually seen the 3-month to 10-year invert. And so what we're seeing right now is a pretty strong signal for a recession. So again, that's a lot of the reason why we're kind of girding for this eventuality, and right now have the current expectation that it's not going to be overly significant. Although I will caveat, I was explaining to this to someone last night, in fact, that we've never seen a situation where the Fed has been raising interest rates and reducing the size of its balance sheet at the same time. So this is a little bit of an unknown, but I do think the Fed being more aggressive on the front end will generate slowing growth, and we'll see some of these charts coming up, slowing growth a little bit sooner that will bring them to a point of pause a little bit sooner and maybe begin to err on the side of caution on not wanting to torpedo the economy but even still with inflation being above target. Here's some information from Goldman Sachs, the length of hiking cycles. So you see all countries on the left and then the US on the right-hand side, and you can see that this number, honestly hasn't changed a whole lot. If you look at, whether you're looking at after 1985 or the period of 1970 to 85 or 1960 to 70, we've talked about the length of market cycles and the length of hiking cycles, which tend to more tightly correlate to recession periods. And you see, that hasn't changed a whole lot. And so, you do have varying tightening cycle periods. We're going to see a chart in a moment that will suggest that we've seen the majority of the hiking that we're going to see in this cycle. But you just see that not much has changed in terms of the duration of these hiking cycles over time. As I mentioned here, if you look at the right-hand side, and this is the magnitude of policy increases on the x-axis, on the horizontal axis, and on the vertical axis is the percent of cycles in which you see that. And so the way to describe this, and I'm going to focus on the right-hand side of this chart right now, is that in 30% of the cycles, you see maybe 100 to 200 basis points, and then that goes down. So when you go 200 to 300 or 2 to 3%, then that's a little less frequent, under 20%. If you go 300 to 400 basis points worth of tightening in a tightening cycle, that's even less of a percentage of probability. And then, the current expectation that's being built in, and that's that dotted line, two dotted lines there. Actually, one, you can see the current ECB or European Central Bank projection about 325 basis points, and the current Fed projection is about 475 basis points. And you can see the frequency of that much of a rate increase or tightening cycle, if you will. It's actually fairly infrequent. And if you go much higher than that, with going from 475 basis points, in fact, based on what we saw earlier in this chart, that could even be closer to 5.25 percentage points of tightening. And if that's the case, then that happens basically about 5% of the time. So again, the tightening cycles are typically not nearly as robust as what we're looking at here in this current rate hike tightening cycle. Here's a 10-year Treasury yield to 30-year fixed rate mortgage, and these two are inextricably linked because the 30-year mortgage is indexed to the 10-year Treasury. There are times where this deviates a little bit. And actually, we saw that last year in 2021 where, it didn't correlate nearly as well. Of course, we had in 2020, we were dislocated in a lot of areas because of the pandemic. But you can see both of those moving higher. 10-year Treasury punching through 4%. You can see where the 30-year mortgage is punched through 7%. Now, the magnitude of this difference right now is actually fairly strong. And you can see over time that this is the difference between a 30-year mortgage and the 10-year Treasury right now is as robust as it's been since essentially the last century, that being the 20th century. So kind of unusual times, but you can see that these rates have moved clearly quite a bit in a relatively short period of time. Here's homeowners that could save money by refinancing. We've talked about the lack of homeowner mobility now, that i.e., homeowners that are looking to downsize or looking to relocate, they're less, or I should say more reluctant to do that now because interest rates are much, much higher, and they'd be trading a low rate mortgage for something that's considerably higher. And this is just a chart that kind of confirms that whole negative economic situation that, if you refinanced your current home, this doesn't have anything to do with necessarily with people moving, but if you refinanced your home, could you save money? And the percent of those people that are in that boat are actually very few and far between, because there's virtually nobody out there that has an existing mortgage that is of a rate structure that we currently have in priced into the market. So, basically refis have gone to zero, and you see very little activity in that mortgage market right now. Compensation for private sector workers. This is, all part of that compensation wage equation. It's a very broad topic. And so we know that wages have gone up. We know that that's a component into the inflation picture. And we also know that it's fairly sticky. What's interesting here is that, we do see not green shoots, but we see like evidence here that it's rolling over, both on wages and salaries and on the benefits side. Now, this is a rate of change year over year. So I want to caution you against thinking that things have kind of rolled over, because the rate of gain is still over 5%, which, of course, as we know, is not as high as the rate of inflation right now. So we know that real compensation is still moving in negative territory. But this is one of the things that the Fed is watching, compensation wages, to see if the rate of gain is rolling over, and that's a measure of how effective these rate hikes are. And I'd say the jury's still out, but the last set of data is trending in what I will call the positive direction, even though it implies that compensation is rolling over a little bit. Price pressures, CPI. This is just a kind of a forecast, if you will. This is Morgan Stanley with historical data from the Labor Department, but you can see the trajectory of inflation, and right now you see core prices being a little bit stickier at a higher level. I do think that is going to be the case. And you look at about the middle part of 2023, and the estimate for core inflation still about 4.6%, and then the all-in inflation rate closer to about 3%. I think that is actually fairly reasonable. Inflation can change pretty quickly, but when you have the rate of inflation that we have now, it tends to be a little stickier. So as we talked about previously in these charts of the week and in market minutes, this has been a very difficult year in which to manage money, probably the most difficult year since 2008, and you have had no real diversification benefits from other asset classes. You've had a lot of erosion in the fixed income markets, and this chart indicates that you've had trouble even with gold at a time where you see kind of the purchasing power erode due to inflation. People tend to hold the precious metal, and even gold is down. Gold flows are not only is the metal down, but flows are down as well. And so this chart depicts that. And so we've had considerable investor outflows from gold. And in fact, the most durable decline in net investment in gold since 2013-14. Jobless claims we see here, it's kind of straddling the 2019 weekly average, and we know that the labor supply is impacted by several things. Obviously, the participation rate is part and parcel, probably the most important thing that we should be watching, and we know participation is off. But we look at jobless claims. I mean, that's just kind of a pure and unadulterated view of the current labor environment. You can see that we're kind of holding to this average. So we really haven't seen the weakness in labor that you would expect at this point in time. And again, this is one of those other things that in that basket of things that the Fed is watching to kind of gauge its monetary policy. Here's world trade as a share of global gross domestic product, or GDP. And you can see here that global trade is pairing off. We know that the world, this is a kind of a synchronized slowdown, and most of the world tends to follow the U.S. And I think that's clearly at work now. We can see this trend line on this data series that goes back to 1990. You can see various points where there have been an impetus towards global trade growth, like NAFTA, obviously. But we started to roll over when during the Trump administration's Chinese tariffs, which largely have been left in place with the Biden administration, and we can see here that global trade is definitely off its peak. Global manufacturing PMI. This is more evidence that the global economic situation is softening. You see the global, the all-in PMI number up on the top. You can see that below the midline, which anything below 50 represents contraction. So we know the global economy is contracting, excuse me, and the rest of the world is much more beholden to manufacturing than we are. Obviously, we've offshored most of our manufacturing over the last several decades, and in some cases are trying to basically reshore that. But we've become largely a service-based economy. But overseas, manufacturing matters a lot more, and so this is indicative of the global market slowdown. And you can see here that all phases of the PMI are affected, whether in the consumer sector, whether it's in intermediate stages of production or investment goods, which are more, large dollar capital items. They're all rolling over. Global PMI versus the monetary policy cycle. And so, why is this important? Because, this essentially the blue line is what we just looked at. And so it does tend to be a leading indicator on what's going to happen on monetary policy overseas. It seems pretty intuitive, but this is just a representation of it. So when you pull, that data forward and basically you offset, the policy decisions by about 11 months, it actually overlaps fairly strongly. And so I think, here what this suggests is that we're predisposed to have more what I'll call rate decreases over time than increases. Here's something that caught my eye. Interesting to watch the trend in monthly payments for new and used vehicles. Obviously, with the interest rate increase, we've clearly seen the impact on the housing market with mortgage rates moving above 7%. And so the same is really across the board for anything that's being financed right now. And obviously cars typically are financed, except for the relatively rare cases where they're bought in cash. But you can see here that the average price, looking back over the last year and a half, roughly, the average monthly payment is up over $100 for new cars, and then for used cars, actually the percentage change year over year is actually much higher than on new cars. But just one more manifestation of higher interest rates on the, I guess I'll call it the curb on purchasing power for the average household. Now, as we kind of look at some other areas, we've got publicly held federal debt as a share of GDP. And I've mentioned quite often that the consumer and the average company is in relatively better financial shape than they were back when we were dealing with the global financial crisis, and that is true. But given the expansionary tendency of fiscal policy, obviously we have more debt outstanding, and as a consequence, more publicly held federal debt as a share of GDP. Now that is off a little bit in the last couple of years, but you can see the spike during the pandemic where we did have to finance a lot of the stimulus payments, and so I would focus more on the aggregate numbers rather than necessarily the rate of change, although the rate of change is positive. But when you look at where we are, we peaked at over 100% of GDP. That number now is closer to about 95% of GDP, but still relatively high. And so that's something that we're going to have to contend with. A lot of that debt it will be rolling over in stages at arguably higher interest rates. So not only that, it really kind of an offset. So a higher debt burden on us as taxpayers, but a higher yield and higher return for those who are savers. We'll look at the Institute for Supply Management Services PMI. Again, services mean more to the economy than manufacturing does. And so when we look at this, the one thing that we can glean here is that we are still in expansionary territory. Anything above 50 represents expansion, but we're not necessarily as robust as we have been. I'd say we're probably close to the average services PMI that we've witnessed over the last decade or so. But that's clearly going down. And so, when we talk about certain elements of the economy that seem to belie, the impact of higher rates, well, this is one of them. Although, directionally, you can see that the number's going down. And obviously, we're going to monitor that over the coming months. And I suspect it'll continue to go lower as we get closer to this kind of recessionary event, if you will. Services inflation mapped against CPI. So these are, this is the ISM Services Price Index in the red, and it's pulled forward by 3 months, and you can see the overlap it has over CPI. And so, as you look at services and the price index rolling over, and we've seen in multiple cases where prices paid for manufacturing, prices paid for interim intermediate products available for sale and cost inputs for raw materials. We see all of those things really moving lower. And here, as we switch over and we look at the services side, and you see the price index rolling over, that does have some pretty good predictive qualities here. And so looking at this, I think what's clear is that we are going to see that CPI roll over. And given the tight correlation that you have with these two data series, again, the services number is pulled forward by 3 months as a leading indicator, and if this holds true, then you can see several percentage points of inflation coming off the top over the coming months. So here we've got a plot of the ISM manufacturing prices paid and services prices paid. So both of these are very important. Both of them are trending in the same direction. There's a relatively high correlation between these two. Not perfect, but it is positive. And so again, as we talk about prices paid, we talk about input costs into either the production channel or the service channel. Those are rolling over. We see it in the data. It's right here in front of us. And so we know that prices are rolling over. We know supply chain issues are resolving because demand is off. But the pace is the uncertainty right now. How quickly is this going to transpire? And if it happens more quickly, then the Fed is apt to hit the pause button a little bit sooner. The market before the rate increase last week thought that was actually going to begin to happen at their next meeting in December. Well, now that feeling has been pushed out a little bit. But again, these numbers are pretty compelling. This data and these charts are pretty compelling visually. And so I think, when you get into January, February, you're going to see some material changes in prices paid and the input and the influence rather on inflation. As we saw in that last chart, the data suggests that we could see CPI drop by 2-3 full percentage points from where we are. Again, that's above the Fed's target, but that's clearly an improvement off of where we are today. We look at manufacturing. Here's manufacturing's new orders month over month for durable goods, excluding transportation orders. So takes out a little bit of the noise here. We see that those orders have now moved into negative territory. Again, this is demand destruction that is very typical with a rate tightening cycle. So again, this does not surprise me in the least bit. And this is all very consistent with what we would expect. So again, you have your kind of like your green shoots, if you will, that are kind of like stubbornly positive in an odd kind of sense. But then you have, new orders month over month that are definitely rolling over. And so this is this balance of the data that is causing some confusion right now. And I do think that in the coming months, you'll see a preponderance of the relevant data that people are watching that will be consistent with what you see in this chart, which is kind of like moving into negative territory and just a general environment slowing down. So just as we came off the last quarter's data for economic growth, again, that data, that quarter was supposed to be pretty soft. And we're apt to get two more revisions of third quarter GDP. First revision being, or the first data point that we got, the first revision was up 2.6 on an annualized basis. Now we look at this chart. This is the Atlanta Fed GDP now, which did the best job of forecasting the positive economic growth surprise that we had. And it moved up quite a bit. Now, right now, we've got blue chip economists, or the consensus, the blue chip consensus of economists forecasting fairly low growth. And there is a wide band. So you see a lot of economists out there that are predicting negative growth, and some that are predicting somewhat tepid growth. And you see in that green line, though, the Atlanta Fed GDP now estimate is looking for something on the order of around 3.5%, which is completely out of the consensus right now. But when they issued their third quarter forecast, they were clearly out of the consensus, but they were pretty much right. So this is very interesting. It'll be fun to watch this in the coming month or two. Now, given this is an estimate for the fourth quarter, which will end at the end of next month, and so we still have the majority of the quarter to go in terms of economic performance to get to this number, which will be announced at the end of January. But right now, interestingly enough, we have the Atlanta Fed suggesting that number is actually going to be pretty good. So we look here, we've got companies repurchasing stocks. I'll have to admit that I know in 2021 that number was really high. Companies were returning a lot of capital back to shareholders, and we saw a lot of acquisition activity, and we saw a lot of with these reverse mergers and what they call SPAC transactions, a lot of acquisitions out there. I haven't seen that this year. Acquisitions are way down, IPOs are way down. Basically merger activity is way off, but yet you still have a really strong repurchase activity out there. Of course, a lot of rhetoric about the legislation about taxing these repurchases, taxing, dividends. A lot of rhetoric out there about the fact that, some companies that may have surplus cash flow, well, by golly, they shouldn't have that and it should be taxed. But what you can see here is that you've got a lot of repurchase activity out in the market, which, again, as I'll reiterate, I'm quite surprised at that. So here we have a scatter plot of, and I've shown you several scatter plots over the last several weeks. So when you have a drawdown of greater than 33%, and this chart gives you all of this data. So if you have a drawdown of, it starts off here at negative 20%. So if you have a drawdown at 20% to 25%, more often than not, the next year you're going to have a positive 1 year return. In some cases, you're going to have a pretty strong return 1 year later. And so that's what this scatter plot is all about. Now, when you're only down 20 to 25%, like I said, the majority of the time you're up, but there are, I'm going to guesstimate here that maybe about 25% of the time you're going to have another negative year. Well, obviously we don't want that, but when you have a max drawdown of 33% or more, there has never been an occasion where the following year has been negative. Never. You can see that gold line there represents, in fact, if you look at even negative 30% or even negative 27%, which there is a data point there at negative 27%, on a drawdown. There's only been one occasion going all the way up to negative 27% where the following year was negative. And in every other instance, the market was positive. And so, as we sit here and we look at our max drawdown year to date of around 27%, that should make you feel relatively good for the following year, because this is the data that goes back to 1950, and this is pretty powerful stuff. Now, granted, we're in a very unusual year in which the 10-year Treasury and the S&P 500 are both down 10%, and that is literally like a 1 in 100 probability. So odd things are going on this year, but the data strongly suggests that you're going to have a better next year. Now, all bets are off if we have a deeper recession, but if we have the kind of recession that I think we're going to have, I think this scenario is very possible that you have a positive performance next year. But let me caveat that there could be some more pain between now and when we find that trough in the eventual next market cycle. Here's equity mutual fund and exchange traded funds, weekly net inflows. And so, we've been talking a lot about, an exodus into so-called quality. We've seen a lot of inflows into bond funds, and you'll see here in a second, there's been a lot of move into cash. A tremendous amount of funds being moved to cash, which I think in some cases can be a contrarian indicator. But what's really interesting here is, we look over the last several weeks, we've had some pretty strong equity inflows, again, for mutual funds and exchange traded funds, or ETFs. And that breaks a trend, by and large, that we've seen over many, many months now. Here's growth versus value. This is a kind of a factor thing that I've been watching. It's one of the many factors that you could invest in. Small versus large, dividend versus non-dividend. You've got growth versus value here, and you could see that growth is really underperformed. And so the portfolios that are positioned with high quality, capital strength, lower growth, but high dividend paying, high cash flowing firms, those are the ones that are outperforming right now. Bond market volatility remains extremely high, although I think we may have found a peak. Obviously, the rate increase this week was not the most important thing, because that was largely expected. It was the rhetoric that suggested that we're going to continue to see these outsized rate increases into next year, which really unnerved the bond market. And so as a result, we've seen volatility in the bond market that we haven't seen in a long, long time. Cash as a percent of individual investors' portfolios, you can see that number has moved up considerably. The long-term average here, for better or for worse, is like 16%. I'll call it, maybe a little bit more than that, which obviously is much higher than what I would carry in our portfolios. But just on a relative basis, if you assume that 16, 17% is the average, right now that number is pushing through 24%, and that is extremely high. Again, we saw that during the pandemic, but we haven't seen that in a long time. And so, as I said on the prior slide, I think this is kind of in some sense a contrarian indicator. When cash portfolios are pretty high, that tends to indicate individual investor preference, to safety over risk taking, and even to the point of capitulation, saying, listen, I've had enough of this, I'm out, I don't care what the valuations are, I just can't handle it anymore. And I think there's some of that that's going on, that people have kind of checked out, cashed out, and they're sitting on the sidelines. Unfortunately, most of those folks haven't read any of the literature on how to get back into a market. And oftentimes when you hold this much cash in a downturn, you don't get it redeployed as the market is turned around. And so, you got to be careful about holding too much cash. But again, I think this is a symptom of, maybe not quite the capitulation that we need to see a better market, because I think the economic data is going to continue to be soft. But it is helpful in perhaps projecting or setting the conditions for which a bottoming process can take place in the market over time. Equity sentiment is down. So, what's interesting here, this dovetails really nicely with the prior chart with cash balances, but sentiment's down, and you look at this these rolling bands, and we're getting, we're just like hugging, this extreme bearishness sentiment, which is actually bullish for stocks. And so I think, after the Fed rate increase and the fact that even though we ended on perhaps a positive note, but negative for the week, we're much closer to a buying point than we are to a selling point. That will do it for the charts of this week. I hope you've enjoyed it. Please feel free to reach out if you have any questions. Hope you have a wonderful week, and take care. We'll talk to you soon.